When I look back at the beginning of my trading journey, I realized that what I was doing in my 20s was not really trading. It was closer to gambling. I was fascinated by the markets, and I was reading every book I could find about indicators, strategies, and market behavior. But the truth is that information alone did not make me a trader. Inside my mind, there was confusion, excitement, fear, and the constant desire to prove that I could beat the market. One of the biggest lessons I learned early is that a trader can easily fall into a mental trance. It is similar to driving on a long highway. You hold the wheel, you look forward, and you believe you are fully in control. But in reality, your mind drifts away, and you are simply following the road automatically. In trading, the same thing happens. Many traders think they are making conscious decisions, but they are actually reacting emotionally without awareness. My professional background was in psychiatry, and that gave me a unique perspective on trading. I understood very clearly that the real battlefield of trading is not the market. The real battlefield is inside the trader's mind. Every decision in trading is influenced by emotions such as fear, hope, pride, and frustration. If a trader does not understand these forces inside himself, the market will expose every psychological weakness. For a long time, I struggled even with writing. Whenever I had to write something, I would feel blocked. It felt like there were two different people inside my head. One was the writer who wanted to express ideas freely, and the other was the editor who kept criticizing every sentence. The editor kept saying, "This is not good enough. You should say it differently. This must be improved." That internal conflict would completely paralyze me. Eventually, I realized something important about the mind. When you try to do two mental tasks at the same time, you create internal resistance. So I made a simple rule for myself. When I write, the writer works and the editor stays out of the room. Only after the first draft is finished does the editor come back. That simple mental separation changed everything for me, and it also taught me a powerful lesson about how the mind works under pressure. Subscribe to Live Trading Mindset and follow the real journey of becoming a disciplined trader. Here we document the psychology behind every trade, the mistakes, the lessons, and the process of building consistency in the markets. If you are serious about trading and working on your mindset, this channel is for you. Trading requires the same kind of mental clarity. When you are in a trade, your mind must be focused on execution, not on endless internal arguments. Many traders sabotage themselves because they allow too many conflicting voices inside their heads. One voice says, "Hold the trade." Another says, "Close it." Another says, "Double the position." That mental noise creates hesitation, and hesitation is extremely expensive in trading. Over the years, I also noticed that many traders are not destroyed by lack of knowledge. They are destroyed by their own ego. They want to prove that they are right. They want to win. They want to look smart, and they want to feel superior to other traders. That emotional need pushes them to take unnecessary risks, to hold losing trades too long, and to ignore the rules they themselves created. The market has a brutal way of dealing with arrogance. It does not care about your opinions, your intelligence, or your past success. The market only responds to discipline and emotional control. When a trader becomes too confident or too proud, he begins to bend his own rules. At first, nothing terrible happens, but eventually the market delivers a painful reminder that discipline must always come before ego. One of the most important realizations in my life as a trader is that success in trading is deeply connected to self-awareness. You must observe your own thoughts, your impulses, and your emotional reactions. The market constantly triggers psychological responses inside us. Fear appears when we see losses. Greed appears when we see profits. Hope appears when a bad trade refuses to recover. A professional trader learns to watch these emotions without letting them control his actions. You cannot eliminate emotions completely, but you can learn to recognize them and prevent them from making decisions for you. That is the real psychological edge in trading. It is not about predicting the market perfectly. It is about maintaining mental balance while uncertainty surrounds every decision. In the end, trading becomes a journey of personal development. The charts are only a mirror. They reflect your discipline, your patience, your impulsiveness, and your emotional stability. When traders focus only on strategies, they miss the deeper lesson. The most powerful improvement does not come from a new indicator. It comes from understanding and managing the mind that is pressing the buy and sell buttons. One idea that shaped my thinking about traders came from a professional money manager in Chicago named Brian Moneson. He once joked in an interview that he had a PhD in mathematics and specialized in cybernetics, but he managed to overcome these disadvantages and make money trading. What he meant was simple and surprisingly true. The more formal education people have, the harder trading often becomes for them. Many highly educated people approach the market believing it must be extremely complex. They think success requires advanced mathematics, complicated formulas, or sophisticated theories. But trading is not that kind of game. In reality, the market only gives us a few simple pieces of information. We see price, movement, and activity. The real challenge is not intellectual complexity. The real challenge is emotional control. Over time, I began asking myself a question that bothered me for years. Why do intelligent people keep losing money in the markets? They read books, they understand strategies, and they analyze data carefully. Yet many of them still fail. Eventually, I realized something uncomfortable but important. Many people are not really trading to make money. They are trading for psychological reasons. Some traders are looking for excitement. The market becomes entertainment, a way to escape the routine of everyday life. Others trade because they want recognition. They want to impress other traders, to prove they are smarter than the crowd. These motivations are rarely conscious, but they influence behavior in powerful ways. When trading becomes entertainment or ego validation, discipline disappears. Discipline is very easy to talk about when the markets are closed. On a quiet Sunday, every trader feels calm, rational, and perfectly disciplined. It is easy to promise yourself that tomorrow you will follow every rule. But the real test comes when the market opens and prices start moving. When money begins to fluctuate, emotions quickly replace logic. That is the moment when the trader's mind becomes the real battlefield. Fear appears when a trade moves against you. Excitement appears when a position starts making money. Hope tries to convince you to hold a losing trade longer. Impatience pushes you to enter trades that were never part of your plan. All these psychological forces begin fighting for control of your decisions. One of the biggest problems traders face is something I call mindlessness. Many people simply repeat the same behaviors without thinking. They trade out of habit instead of awareness. The solution is mindfulness. A trader must pay attention to his own mental state, his emotions, and his level of preparation before entering the market. To help myself stay aware, I developed a simple psychological check that I use before trading. Every morning, I ask myself a few honest questions about my condition. How do I feel physically? Am I tired, sick, or full of energy? How did I perform the previous day? Did I lose money, win money, or stay neutral? These questions help me understand my mental readiness. I also ask myself how prepared I feel for the trading day and what kind of mood I am in. Mood matters more than most traders realize. A bad mood can lead to impulsive decisions, while excessive confidence can lead to overtrading. Even something simple like being too busy or distracted can affect the quality of your decisions in the market. This self-check takes less than a minute, but it gives me valuable information about my psychological state. Sometimes the result tells me that I should not trade at all. Many traders believe they must always be in the market, but a professional trader understands that protecting mental clarity is more important than forcing trades. In the end, the solution to many psychological problems in trading is structure. The mind needs a clear framework to operate within. That is why written trading plans are so important. A plan removes many emotional decisions from the moment of pressure. Instead of improvising under stress, the trader simply follows the structure he prepared while thinking clearly. When I think about market psychology, I always start with a simple observation about human behavior. When people are under stress, they look for guidance from others. It is a natural instinct. We want reassurance that our decisions are correct, so we search for opinions, advice, and confirmation. But the market is a very special environment. Unlike many other areas of life, the market is not friendly or cooperative. In normal life, if you make a small mistake, other people usually try to avoid harming you. But in the markets, the situation is very different. The market is extremely competitive. Every participant is trying to take money from someone else. When you enter a trade, you are entering a battlefield where other traders are actively trying to exploit your mistakes. Because of this pressure, many traders make a psychological mistake. They enter a trade and immediately start searching for other people's opinions. A trader buys a stock and then goes online to read forums, social media, or chat rooms to see what others are saying. This behavior is extremely dangerous because it weakens the trader's independence. If you had a clear trading plan before entering the trade, why would you suddenly look for opinions after you are already in the position? The moment you begin searching for external validation, your confidence in your own system begins to weaken. Instead of following your plan, you begin reacting emotionally to other people's comments. I have seen many traders lose discipline this way. They enter a trade with a clear strategy, but after reading a few opinions online, they begin doubting themselves. One person says the stock will explode higher, another says it will crash. Suddenly, the trader is no longer following a plan. He is simply reacting to noise. This is why independence of thought is one of the most important psychological traits in trading. There is an interesting idea described in the book, The Wisdom of Crowds. The book explains that crowds can sometimes produce intelligent results, but only when individuals make their decisions independently. When people start copying each other, the intelligence of the crowd disappears. That idea influenced how I think about trading groups. In my trading community, traders submit their ideas independently before seeing what others are doing. This structure protects individual thinking. Each trader must rely on his own analysis and judgment rather than simply following the crowd. One of the most memorable lessons about independence came from a famous market analyst named Joe Granville. When I visited him years ago, I noticed something unusual about how he followed the markets. He had the financial news channel on television, but the screen was covered with a cloth so he could not see the commentators. The sound was muted as well. All he could see was the price ticker moving at the bottom of the screen. He deliberately removed the opinions and commentary. He wanted to isolate himself from the emotional noise of the crowd. By doing this, he protected his own thinking from outside influence. Isolation from the crowd is not about arrogance, it is about psychological clarity. When traders constantly listen to other opinions, their minds become confused. Confidence turns into hesitation. Discipline turns into doubt. The trader stops acting according to his plan and begins reacting to the emotional energy of the crowd. Another psychological trap appears when traders start talking about their positions with friends. Imagine you tell everyone that you bought a stock because you believe it will rise. At first, the trade moves in your favor, and you feel proud, but then the market turns and begins moving against you. Now, something interesting happens inside your mind. Instead of evaluating the trade objectively, you begin protecting your ego. You do not want to admit that the idea might be wrong because you already told others it was a good trade. Pride begins interfering with judgment, and the trader holds the losing position longer than he should. This is why experienced traders often follow a simple rule. Do not talk about your positions while they are open. You can discuss trades after they are closed when emotions are no longer involved. But while the trade is active, the most important thing is to protect your psychological independence. In trading, your mind is your most valuable asset. The moment you allow outside opinions, ego, or social pressure to influence your decisions, you weaken that asset. The market rewards traders who think independently, follow their plans, and remain mentally detached from the emotional noise of the crowd. One of the most important things I learned as a trader is that once you make a decision, the responsibility is entirely yours. Sometimes I share ideas with a few trusted friends, people who also trade and understand the markets. But even then, the final decision must always come from my own system. Advice can exist, opinions can circulate, but in the end, every trade belongs to the trader who takes it. This idea becomes even clearer when you start thinking about what a chart really represents. Many traders look at charts as if they were abstract pictures made of lines and bars, but the truth is much more human. Behind every single price on the screen, there are real people making decisions. Every transaction exists because one person decided to buy and another person decided to sell. Even when algorithms are involved, there are still humans behind them. Someone designed that system. Someone programmed those rules. In the end, the market is still a reflection of human thinking and human emotion. Every movement in price is the result of countless individuals making decisions under uncertainty and pressure. When we look at a chart, we are actually observing the behavior of a crowd. Sometimes that crowd becomes confident and pushes prices upward. Other times, the crowd becomes fearful and pushes prices downward. And often the crowd becomes confused, creating periods where the market moves sideways while people struggle to decide what to do next. What makes trading psychologically difficult is that it is very easy to recognize patterns after they happen. When we look at the past, everything seems obvious. But trading does not happen in the past. It happens at the right edge of the chart, where the future is still unknown. At that moment, the trader must make decisions while uncertainty and doubt are present. Another important realization is that every price is the result of a balance between buyers and sellers. Imagine a stock trading at a certain price. That price exists because someone believes it is worth buying, while another person believes it is worth selling. The market constantly finds this temporary balance between opposing opinions. But around these active participants, there is also a much larger group of observers. These are traders who are watching the market closely but have not yet acted. They are thinking about entering. They are waiting for the right moment. Their presence also influences the market because active traders know that these potential participants may soon step in. In that sense, the market is a living psychological environment. There are buyers, sellers, and observers all reacting to the same information. Everyone is watching the same prices, but each person interprets those prices differently based on their expectations, fears, and beliefs about the future. When you decide to enter a trade, you are essentially challenging the opinion of the entire market at that moment. The market says the asset is worth a certain price. By buying, you are saying that it is actually worth more. By selling, you are saying that it is worth less. In that moment, you are standing against the collective judgment of thousands of other participants. This is why trading requires a certain kind of psychological courage. You must be willing to act on your analysis even when the crowd believes something different. At the same time, you must also remain humble enough to accept when the market proves you wrong. Pride and stubbornness are extremely dangerous in this environment. In the end, every point on the chart is a snapshot of collective human belief at a specific moment in time. It represents the temporary agreement of the entire market about value. When you trade, you are not simply interacting with numbers on a screen. You are interacting with the combined psychology of thousands of individuals making decisions in real time. When I studied the history of technical analysis, I learned that it began a long time ago with Charles Dow, the man behind the Wall Street Journal. His revolutionary idea was very simple. He believed that prices reflect everything. All knowledge, all expectations, all fears, all optimism, smart money and foolish money, everything eventually shows up in price. That idea was powerful because it meant that by observing price, we are really observing human behavior. But over the years, I realized that the real value of charts is not in drawing complicated patterns. The real value is understanding the psychology behind price movement. Every chart is a picture of collective human emotion. It shows moments of confidence, fear, panic, hope, and disappointment. When traders look at a chart, what they are really studying is the behavior of the crowd. One thing I discovered in my own experience is that traders often make things far more complicated than they need to be. Many people try to draw endless lines, patterns, and shapes on charts, but the market itself does not care about those drawings. What really matters is the psychology of buyers and sellers and how their expectations change over time. When I observe the market, I am always asking a psychological question. What did the crowd expect, and what actually happened? When traders expect the market to move strongly in one direction and it suddenly fails, something important has happened inside the mind of the crowd. Confidence has turned into doubt. Optimism has turned into hesitation. These moments are powerful because they reveal emotional shifts. When many traders expect success and suddenly face failure, their psychology changes quickly. Fear replaces confidence. The same traders who were aggressively buying a moment ago begin rushing to exit their positions. This emotional shift is often what drives the next movement in the market. What fascinates me most about markets is that they are a living display of human nature under pressure. When money is involved, people behave in very predictable psychological ways. They become hopeful when they should be cautious. They become fearful when they should remain calm. They chase opportunities when excitement is high and abandon them when fear appears. The market constantly exposes these emotional weaknesses. It shows how quickly confidence can turn into panic and how easily crowds can move together from optimism to fear. When traders experience losses, many of them react emotionally instead of rationally. They try to prove they were right instead of accepting that the market simply disagreed with them. Over time, I began to see that charts are really a language of human behavior. They tell stories about the crowd. A sudden failure after strong enthusiasm shows that the crowd tried something and it did not work. When traders see that failure, many of them begin changing their positions. That shift in behavior often drives the next move. What makes markets so fascinating is that this psychological behavior is universal. It does not matter if you look at markets in America, Europe, or Asia. Human beings respond to uncertainty and pressure in the same ways everywhere. Fear, greed, hope, pride, and regret appear in every market because they are part of human nature itself. In trading, we are constantly interacting with this crowd psychology. Every trade is a decision about how the crowd may react next. When you buy, you believe others will soon become more optimistic. When you sell, you believe the crowd will begin losing confidence. Trading is essentially a game of understanding emotional shifts within the market. This is why I always say that trading is not really about predicting prices. It is about understanding behavior. When you learn to recognize how the crowd reacts to success, failure, and uncertainty, you begin to see the market differently. Instead of seeing random price movements, you start seeing the emotional footprints of thousands of traders reacting to the same pressure at the same time. In other words, if you study price behavior, you are really studying human behavior. That idea changed the way I looked at markets. Instead of focusing on endless external information, I started thinking about what price really represents. Price is the result of thousands of traders making decisions at the same moment. Some are confident, some are afraid, some are early, and some are late, but all of their emotions and beliefs combine into a single number that appears on the chart. Over time, many complicated chart patterns were developed. Traders began drawing shapes, lines, and formations on charts in an attempt to predict the future. But I eventually realized that many of these patterns are extremely subjective. Two traders can look at the same chart and see completely different structures. What one trader calls a pattern, another trader might completely ignore. This subjectivity is actually a psychological trap. When traders want to believe something strongly, their minds begin to interpret the chart in ways that support their existing bias. If a trader is bullish, he begins seeing bullish patterns everywhere. If he is bearish, the same chart suddenly looks full of bearish signals. The chart becomes a mirror of the trader's emotions rather than an objective observation. Because of this, I prefer focusing on ideas that make psychological sense. One of them is the concept that traders remember important price levels. When a market previously reversed at a certain level, many participants remember that experience. When price returns to that area, those memories influence behavior. Traders who missed the move before may act quickly, while others try to protect previous profits. Another powerful psychological moment appears when the market attempts something and fails. Imagine the crowd becomes very confident that price will continue rising. Everyone expects a breakout, and traders rush to participate. But suddenly the market cannot hold the new level and begins falling back. In that moment, something important happens inside the crowd's mind. Confidence quickly turns into doubt. Traders who were enthusiastic a moment ago begin questioning their decisions. Some rush to exit their positions, others feel trapped, and many become uncertain about what to do next. This emotional shift often creates powerful movements in the opposite direction because the same traders who pushed the market upward are now trying to escape. What fascinates me about these moments is that they reveal the psychology of the crowd very clearly. The market tries something, the crowd becomes excited, and then reality proves that excitement wrong. That moment of failure forces thousands of traders to reassess their beliefs at the same time, and the result is often a strong change in direction. Another interesting psychological illusion appears when traders look at long-term charts and imagine perfect patience. It is easy to look at a chart years later and say that holding the position from the beginning would have been simple. But the reality is very different when you experience the movement in real time. When a trader sees a position move strongly in his favor and then suddenly drop sharply, emotions become intense. Fear of losing profits appears, doubt grows, and confidence begins to fade. Many traders who believed they could hold for the long term discover that their emotional tolerance is much smaller than they imagined. This is why trading psychology matters so much. The market constantly tests our emotional stability. It challenges our beliefs, our patience, and our discipline. What appears obvious in hindsight was actually filled with uncertainty and emotional pressure when it was happening. In the end, every chart is simply a record of how the crowd behaved under stress. It shows where traders became confident, where they became fearful, and where they lost conviction. When I study a chart, I am not just looking at price movement, I am observing the emotional decisions of thousands of traders reacting to the same uncertainty at the same time. One thing I learned while studying charts is that markets constantly test ideas and then reject them. Think about what really happens during these moments. A large group of traders becomes confident that price will continue in one direction. They commit money, they feel certain, and they believe they are on the right side of the market. But when the market suddenly reverses, their confidence is shaken. The same traders who were enthusiastic a moment ago begin to feel doubt and fear. That emotional reversal creates powerful pressure in the market. Traders who entered with confidence now want to escape their positions. Others who were waiting on the sidelines suddenly see opportunity in the opposite direction. In a very short period of time, the emotional balance of the market changes completely. What fascinates me about these situations is that they reveal the psychology of the crowd very clearly. The market tried something and failed. When the crowd sees failure, their belief changes. That shift in belief often produces strong movements because thousands of traders begin adjusting their positions at the same time. These patterns are not interesting because of their shape on a chart. They are interesting because of what they reveal about human behavior. When traders see a market trying to move higher and failing, it tells us that optimism was strong but could not survive reality. That disappointment becomes the fuel for the next move. One of the most important lessons I learned is that these psychological reactions are universal. It does not matter where the market is located or what language traders speak, people react to stress in very similar ways everywhere. Fear, excitement, hope, and disappointment appear in every market because they are part of human nature. I have traded in different parts of the world, and I have seen the same emotional patterns again and again. Traders may live in different cultures, but when money and uncertainty are involved, the human brain responds in remarkably similar ways. The market becomes a global display of how humans behave under pressure. Another thing traders must remember is that the market always looks obvious in hindsight. When we look back at charts, we easily recognize turning points and important moments. But when you are trading in real time, the future is not visible. At the right edge of the chart, everything is uncertain and incomplete. Professional traders understand that recognition takes time. Often the meaning of a move becomes clear only after the next movement appears. The market gives clues, and the trader must patiently observe how the story unfolds before acting with confidence. This is why trading requires patience and emotional stability. Many traders want immediate certainty, but the market rarely provides it. Instead, it gives fragments of information that slowly reveal the psychology of the crowd. A disciplined trader learns to observe these changes without rushing to conclusions. In the end, trading is really an exercise in reading human behavior. Charts are not just lines and numbers. They are records of emotional decisions made by thousands of individuals facing uncertainty. When you learn to recognize how the crowd reacts to success, failure, and stress, you begin to understand what the market is really showing you. When traders first enter the markets, they often become fascinated with all the different instruments they can trade. There are stocks, ETFs, options, futures, currencies, and many other vehicles. But over time, I realized that the choice of instrument is not really a technical issue. It is mostly a psychological one. Different markets create different emotional environments for the trader. For a beginner, I often suggest starting with stocks because they provide a calmer psychological rhythm. Stocks trade during defined hours and then the market closes. That pause is extremely valuable because it allows the trader to step away, review decisions, and think clearly. The mind has time to reset before the next trading day begins. This rhythm is important because trading is emotionally demanding. When markets run continuously, the pressure on the trader's mind becomes constant. There is always something moving, always something happening, and the temptation to react never stops. Many traders become mentally exhausted simply because they are exposed to non-stop stimulation. Another psychological trap appears when traders are attracted to very cheap or thinly traded instruments. Low-priced stocks often move violently in short periods of time. These rapid movements can trigger excitement, greed, and fear all at once. Instead of making calm decisions, traders become emotionally reactive because the price swings feel dramatic. When a market moves too quickly, it becomes difficult to think clearly. The trader starts chasing movement rather than following a plan. That is why I prefer instruments that allow smooth entry and exit without creating unnecessary emotional pressure. Liquidity is not just a technical advantage, it is also a psychological advantage. Some trading products also encourage unrealistic expectations. They promise fast profits or amplified results, which can easily attract traders who are motivated by excitement rather than discipline. But markets tend to punish emotional behavior. Instruments that appear exciting often amplify psychological mistakes rather than trading skill. I also learned something interesting about the psychology of options. Years ago, I spoke with a professional market maker who explained options in a very honest way. She told me that options are essentially a market for hope. Traders buy them because they hope something dramatic will happen in their favor. From her perspective, the professional's job was to understand what the public hoped for and then price that hope. When traders are driven by hope, they often underestimate risk and overestimate opportunity. The emotional appeal becomes stronger than the rational evaluation of probability. This observation taught me something important about trading psychology. Hope is a powerful emotion, but it is rarely a reliable strategy. When traders rely on hope, they stop thinking in terms of probabilities and begin imagining perfect outcomes. The mind becomes attached to possibility instead of reality. Many traders have stories about spectacular wins that came from a lucky trade. These experiences create strong memories because they trigger excitement and pride. But the danger is that these memories distort perception. Traders begin chasing the emotional high of those rare events instead of focusing on consistent decision-making. In the end, the real challenge is not choosing the perfect instrument. The real challenge is maintaining emotional balance while trading any instrument. Markets constantly tempt traders with excitement, hope, and the promise of quick success. A disciplined trader learns to ignore those temptations and focus instead on consistency, patience, and psychological control. Thank you for watching until the end and being part of this journey. Share this video with another trader who is working on discipline and building their mindset in the markets. Write in the comments, "I am in the process." Because becoming a consistent trader does not happen overnight, it is built through discipline, patience, and the process.